Sure. So I just wanted to just let everybody know a little bit about what we're doing in the current environment. So as you know, in the past, like just from the perspective of fixed income for a lot of the last decade has not been an area where you're going to generate much of a positive income return, right? So when I say fixed income, I'm talking bonds, GICs. Which is essentially debt. You're essentially buying debt from the government or from a bank or from a company, and just like with a bond, you're getting a regular coupon payment, which the debtor who you buy it from is legally obligated to make. Usually, it's every 6 months. There's going to be a coupon payment and interest payment, and then your principal, 100% of it, is returned at the end of the maturity date, which could be 1, 2, 3, 4, 5 years, or 10 years, or longer. Um, but things with the way that interest rates have trended over the past 6 months, things have changed somewhat in the fixed income market. So I think it makes a lot of sense for investors, for our clients, that we take a look and reassess how fixed income can fit into an investor's portfolio. We talked about this a little bit at the conference, but I'm really doing a deep dive over the next couple of weeks here, and we're going to put out our fixed income investing report that basically gives people a roadmap for understanding the fixed income investment class, and then implementing a fixed income strategy, which means essentially determining, well, one, whether or not fixed income is an appropriate investor or investment for that individual, understanding what some of the risks and opportunities are, and then looking at what are the practical steps of actually purchasing fixed income securities in your portfolio. So it's pretty interesting because if I were to look at, say, GICs, a year ago, you essentially were getting no return, like in many cases, 1%. I think at some points even less. But nowadays, when you look at GICs, a lot of them are paying 4.5%, even starting to push up to 5%. Now, GICs, they come in different forms, so I think it's important that people understand what's available. I mean, you can, typically when you get a traditional conventional GIC, one of the things that investors need to know is that your money is locked in. You can't sell it like you can with a bond. You can't redeem it early, or potentially you can, but with a lot of fees involved in that really make it not worthwhile. But there are different types of GICs. For example, there's a cashable GIC where you can redeem it, but you're of course going to get a lower interest rate. So those aren't paying 4 or 5%. So understanding what types of products are out there for people, comparing, like, say, a GIC to a bond. If you're implementing a fixed income strategy, a lot of people will say, well, do I just buy GICs? Do I buy individual bonds? Do I buy a bond ETF? So we'll be exploring a lot of that, and just really understanding. So I'll just as an example, this here is the BMO Aggregate Bond ETF. This is ZAG. So this is just like your typical diversified, primarily Government of Canada bond ETF. ZAG is the symbol. So they would own a portfolio of different bonds that are diversified by maturity date. In some cases, diversified by issuer. Most of it's going to be Government of Canada. Some of them are going to be AAA or AA corporate bonds, or just investment grade corporate bonds. But there's a lot of information here. You have your weighted average coupon, you have your annualized distribution yield, your weighted yield to maturity. So if somebody's looking at this, how do you determine what type of income you're actually going to get from this bond? So from this bond ETF. So just essentially looking through a couple of these, giving some examples of how people can purchase a portfolio of bonds and fixed income, and determining what type of asset allocation is going to be appropriate in certain cases. And a lot of cases, people will not need to have any fixed income necessarily, but a lot of people should probably look at purchasing some type of fixed income allocation. Now, another question that I really want to dive into as well, and we've heard this, is in an era of rising interest rates or higher interest rates, does it still make sense to own dividend stocks or dividend growers? So I think that's also an important question to answer too. I've got it's really interesting. Let me share my screen again here. It's a really interesting report that I look at on an annual basis. It's from RBC Capital Markets. And what they do is they analyze the performance of dividend paying stocks and dividend growers over a long-term period. So if you can see here on my screen, dividend paying stocks have outperformed from 1986 to 2021. Dividend growers producing average annual returns, this is for the TSX, of 11.2%. Compare this to non-payers, so companies that don't pay any dividends, 1.4% average. So huge outperformance there, but also lower risk. Annualized volatility, which is a measure of risk, dividend growers 13.2%, a little over half the volatility or half the risk measured by volatility relative to non-payers. So this is I find this really interesting, and I think that even in an environment of rising interest rates or higher interest rates, dividend growth stocks still have a place in an investor's portfolio, because there's certain things that dividend growth does that a bond will not do. So for example, you might be able to get a 3.3% income yield off of a bond ETF right now. But that is those coupon payments that you get, they will never grow unless you buy a bond down the road that has a higher interest payment. But you get what you get with a bond, and it's essentially just a flat fixed coupon payment. But as your bonds mature and you're getting new bonds, if interest rates are going down, you may actually in 5 years be getting a lower income yield on your portfolio. Whereas with a dividend growth stock, one of the things that differentiates the income stream is that if you have a good dividend grower, that dividend is actually growing over time. So 5 years from now, 10 years from now, you're looking at a high likelihood of higher dividends than you're getting today. So we like that. We like that attribute of investing in dividend growth stocks. We like to be able to invest in companies that are growing as well, reinvesting a portion of their cash flow back into the business so that they can grow their earnings, so that they can grow their dividends over time. You're getting the potential of capital appreciation from a dividend growth stock, whereas you're not getting that from bonds. So while for some investors having fixed income in their portfolio is a good idea, having a dividend growth component of your portfolio, we believe is absolutely vital for investment success long term. And if you look at the numbers that I showed you from RBC Capital Markets, you can see you really put yourself systemically at a disadvantage if you don't have an active dividend growth strategy in your portfolio. So how do you combine the two? How do you allocate capital to fixed income? What should you buy? How do you buy it? And then how does this relate to also your dividend equity strategy as well? So we're expecting the report to come out over the next couple of weeks here. And as we have more information, I'll share it on the show.